Okay, volatility has been the name of the game for several weeks now. My next guest, though, believes the U.S. stock market will not see a prolonged weakness in 2026. Let's bring in Brian Belski, CEO and CIO at Cumulus Investment Strategies. And Brian, thanks very much for joining us.
Thanks so much for having us. Good morning, Canada. It's cold here today. Cold.
This is warm with what we've had through the winter. Okay, you look like you're coming from somewhere sunny. I'm jealous.
Well, you know, it's a tough life having a company based in Florida, but we'll get by. We'll get by.
Okay, what gives you the sunny optimism right now with how things are unfolding?
Well, we believe in fundamentals, and we continue to believe that the United States stock market is the highest quality stock market in the world. Followed by Canada, by the way. Canada obviously had a great year last year, something that we called for a few years ago for Canada to outperform, and nobody really believed us. Now Canada did that. We think it's probably time to lighten up on some Canadian positions and really focus on the U.S., given its more diversified nature of its index, number one. Number two, let's just talk about what's happened the last 4 to 6 weeks. The U.S. markets have outperformed the majority of global markets. Gold has underperformed. And I think that actually tells you a lot about the consistency and quality of U.S. equities. And that's why our theme of a 25-year secular bull market for U.S. stocks that we first came out with in 2009 continues to be very much in place.
So we're 2/3 of the way into it of this bull market, you think?
Yeah, I think we have at least another 8 to 10 years. I think some of this quote-unquote silliness of the last 2 years actually adds a couple more years. So here's why. Last year, obviously, we had the tariff and the Liberation Day malaise. This year, we have the malaise with respect to the conflict in the Middle East. Now someone's going to dial in and say, well, every year there's a malaise. Well, not really. We do believe that we will head toward more of a normalized type earnings-driven market, which is our call for 2026 as investors focus more on fundamentals and less on momentum. If you take a look at where the market has been performing, it's really starting to delineate the winners from the losers versus last year. Everything was all kind of going up together. And that's one of those markets where driven by momentum can't last very long. And that's why we are very, very confident in the fundamental natures of U.S. stocks right here.
Okay, and I know with the war, you want people to stay calm and be smart about things. When does it become a real issue or a real concern for the markets to have an impact on? It seems like they've kind of started to factor it in, but when does it become a factor? Is it oil at 150?
It's a great question. I don't know if they factored in, because if you take a look at last week's rally in markets, and now this week we're really focused on, at least today, with this quote-unquote deadline here tonight from President Trump. But I think to use a bond term, not a stock term, I think this is a duration game. We start to see demand destruction, quite frankly, if we see $100 oil for 3 to 6 months, not 3 to 6 weeks. Given the fact the United States of America is the world's largest producer of oil, we're going to continue to pump that out, number one. Number two, with respect to what we've seen in terms of inflation and how inflation can go up like an elevator but down like an escalator, near term I think that's a bit of a concern, but we've already seen investors move into more higher quality areas anyway. So I think this is a duration game, and it's not just a 3 to 6 week game.
And how does this compare? How have previous shocks, geopolitical tensions, how does this one compare, and how did they do? How long did it take to recover from them?
I go back to 1990. This young kid was in the business back then. And I remember my boss at the time, in August of 1990, pulled the entire firm together on the same floor and said, we're heading into recession. We got to cut costs. What did that mean? Half the research department was gone the next day. And then, if you remember, that was when Iraq invaded Kuwait. The U.S. did go into a consumer recession. It lasted exactly a quarter, not 2 quarters, but a quarter. By the end of 1990, we were fully staffed up in research again, and the resumption of the big 82 to 2000 bull market started to go again in terms of momentum in consumer stocks and some tech stocks. So this could end very quickly, and we do anticipate it's not different this time. Once we get this all clear and start feeling better about the news flow and people start to have a little bit more confidence, we believe the stock market's going to rocket.
Okay, but you're saying also, though, in your notes that there's some investor sentiment that it's bearish, and you're calling that a good thing.
Yeah, well, people may think I'm always positive momentum person, but at the end of the day, I'm a contrarian. And we always want to go to where the puck is going. If everyone is negative now and everyone's talking about how terrible things are, we want to be positive and understand that stocks are led by fundamentals. And again, let's go back to the very first thing I said. The fundamental construct of the United States stock market in terms of earnings, valuation, operating performance, the consistency of technical performance, I think sets it apart from other areas. So we're going to be positive. We're not going to focus on emotion. Remember, last year, I came out with a report saying we're not changing anything in our portfolios. We're not going to react to what's happening. And a lot of investors left the United States, and they missed out on an amazing opportunity to own stocks from that April to the end of the year rally. And we're not going to be led by emotion. We're going to be led by fundamentals.
All right, but you're still not ruling out a correction. Excuse me, a correction, though, possibly in 26.
Yeah, I mean, if in earnings-driven markets, they actually are more volatile than fundamentally valuation momentum-driven markets. So when we talked about 2026, we cautioned investors that we are going to have these drawdowns, we are going to have these corrections, we are going to have these moments of doubt, but these moments of doubt and corrections provide opportunities from a longer-term perspective. You should not be selling when everyone's negative. You should be actually looking at your portfolio and figuring out how much dividend growth do I want to own, how much value do I want to own, how much small mid-cap do I want to own, and what does my tech stock component look like for the next 12 to 18 months minimum.
All right, we have to wrap it up there, Brian, but thanks very much for joining us. And do us a favor, take this snow back with you to Florida, please.
I'm going to try, but I will tell you, man, I've got my gloves on. I'm walking around downtown. I am cold.
All right. Cheers, Brian. Brian Belski, CEO.